Majority of our risk is focused right now in the soft markets, where predominantly within coffee and sugar, both are moving into structural deficits. You still have material inventories from the past couple of years of surpluses, but at these low prices, which are unsustainable for the industry, at the aggregate short positions, they're markets that we think are really compelling longs.
When do you think the view turns in the market?
I think in terms of both of them, but probably sugar, probably more imminently, just because you're coming out of the harvest in Brazil. You just had really the peak of the weighty inventory going into September. And so the near-term move is probably more probable in sugar.
What about softs here in the U.S., like corn, soy? I feel like all of them so related to trade. Like, where's the really good opportunity?
Sure. In terms of grains, at the moment, in terms of flat price, we don't have strong conviction. Is the only way we view that there's upside, again, is a single variable. It comes down to China. But is there some interesting in that the hard wheat, which is the Kansas City contract, is trading at an almost dollar discount to soft due to some changes in that contract and some quality issues with soft. But we think that's unsustainable. And so like if you look at the March contract at a 90-cent discount, something like long Kansas City versus Chicago is also, I think, an asymmetric bet.
Do you play the trade headlines when it comes to grains at all? Like, how do you look at it?
We tried in the spring, around March and the May contracts, at times having some long option positions to take advantage of that. But as the trade deals got pushed out, those expired worthless.
But we talked about palladium, right? Didn't you have a potentially bullish view on
palladium is at record prices, at record spreads to platinum. And yet it's still, even from here, is potentially explosive. So you're looking at a just under $1,800 commodity that might need to trade $3,000 to destroy demand. And rhodium, $10,000 as well. Because the two are tied into the auto catalyst market. You're in a deficit, especially as China brings in their emission standards, you ramp up demand there, that we don't see any way that you can solve the balance sheet hole except through destroying demand, and that can only happen with high prices.
So why wouldn't you go long palladium now? Are you waiting for some kind of pullback? Like, do you think it'll be more volatile? One
of the things that we struggle with is we have a modest position in palladium, modest to the point of almost de minimis, and it's in options. You are at record prices, just in absolute terms, and so there's no economic difference between $1,800 palladium and $1,200. It's record price. You're incenting, sort of as much supply and relative switching as you can at that, barring a destructive price. So it's while we believe most likely could double from here, this is something that will be incredibly volatile and choppy. Are
there trades that you want to put on in commodities that you haven't yet, that you're really sort of looking at the right entry point, or you have a thesis on that you're looking at?
We believe that 2021 natural gas is actually starting to look interesting. We think it's too early with the amount of production growth that you still have, and with the unknown variable still in terms of the winter. And so people also have been taught to not price in any instant risk returns forward into natural gas. And so unless you have the 20% probability of a much colder than normal winter, that won't move yet. Okay? But that's something that, relative to how supply is shaping up, delays in certain pipelines like the Kinder Morgan Permian Highway just was delayed, the demand growth, some of the fall off in terms of the interior shale drilling, I think you're setting up where natural gas forward for 21 is starting to get interesting.